So can I start by saying this? I'm really happy with the market response today. I mean, this is not a freak out day. I mean, yeah, it was up, it's down, but this isn't like, if we did this over the summer and we had a hot reading like this, and I do think it was hot, the market would be down 2-3% and be crescendoing in the day. This just feels like maybe the market is starting to take inflation in stride. Now, as for the actual number, I'll tell you right now, I didn't like the 0.5% month over month, right? Because prior to that, you had 6 months that in total, when you're looking at the month over month, it was up 0.9%. Now
energy
you get half of that in 1%.
Food ticked up.
Energy and used cars. Energy and used cars. Okay, so
used cars went down. No, used cars went down.
I'm sorry, then
energy
ticked
up and food ticked up. Now, a lot of that was due to eggs, but still, inflation is sticky.
The detail got missed here, okay, which is that if you look at fuel, right, it's come down since then, all right? If you look at the overall trend, we are where we were a year ago, just before the Ukrainian invasion in terms of gasoline prices. Mm-hmm. So you had this blip up in January, but it's reversed. And what it looks like to me is, this is a little hotter than I would have liked it, but it doesn't look like the overall trend in declining inflation is down. Last thing I'll say on this. 7 months, okay? 7 months, you look at it, the headline CPI is up 1.9%. Now, I know, and we all know, the Fed's looking at core services ex shelter. Here's what's going to happen. If they keep focusing on that while the headline is moderating nicely and they start putting people out of work, nobody's going to give them credit for core services ex shelter. They're going to say, what are you doing? You're putting people out of work while the headline's getting better. They're going to have to play the political tune here pretty soon.
So let's do this. The yields have moved up somewhat significantly, right? The rates market is in lockstep with the Fed now, isn't it? If you look at
it's a big story.
If you look at Fed funds, that's in lockstep.
Yeah.
If not a little hotter than where the Fed itself is. I want you to address that, and then we're going to get to the issue of whether the stock market is in denial or delusional. But you talk to me about what's happened in the rates market.
Let me put some. I don't know if Jim intends this context, but the context of the market doing okay today is in context of what's happening in the rates market. That, to me, is what makes it okay, not terrific, obviously. But if you take a look at the 2-year, the 6-month, anything like that, sharp increase in rates in the wake of this. And what's happened is this dramatic story, Scott, of let me give you the context to that, which is we've been talking about this gap between the Fed and the market for the year-end rate, where the market had built in all these cuts. And those cuts have now gone away, and the market came to the Fed. I'll show you 2 charts now. Guys, the multi-bar chart I got in the back, the Fed rate outlook is the first one. You can see what's happened here. First of all, for the peak rate, the market has gone beyond the Fed here. There, the green line is the Fed, folks, or if you're playing this game at home. And look, the market is now above that 513 average Fed forecast for the August contract. And then look at the year end there, 5.8. It's just 5 basis points separates them now. That was 80 basis points. You can see that more starkly in the next chart, which is the year end rate back on the 18th of January, which is low for the year. The market thought they'd end the year at 434, 70, 80 basis points of cut built in. That's gone away. So now the market has come to where the Fed is, and now the stock market has to adjust, and that's your game, not mine.
Does it need to adjust? No, but that's the big. That's the big setup.
Well, it's adjusted.
Does it need to further adjust the stock market?
Yeah, it does.
Before I would say one thing that's worth pointing out here is the risk no longer is the Fed doing less. The risk now is the Fed doing exactly what it says or more.
Especially with
that's where the risk is tilted now.
Especially with that lodging away from home number of 7.7%.
Yeah.
But seriously, what
that's services, and services we know is 73% of core CPI, and that number remains extremely hot. And that was the thing for me that stood out of all of these numbers.
So what does it mean for the stock market?
Look, I mean, we've seen this year, we've seen growth outperform value, largely because people thought that the Fed was going to eventually pause and then pivot, right? And we would see slower growth. Well, we are going to see slower growth, but the Fed is not going to change their tune anytime soon. Not with all of these numbers. Headline, core, super core, like I just mentioned, services.
So is that trade now in big trouble? Because Leisman today on Squawk said about the cut pivot story, the cut story's over.
Yeah.
That's what you said. Right? That ship has sailed, or yesterday's news.
But, Scott, I don't think this is terrible, right? And because I think earnings actually matter more. And earnings actually have been okay, not great, right? 80% of the S&P 500 report, 69% have beat.
Yeah, but that doesn't matter.
Fine, maybe. Yes, it actually does.
No, it doesn't. If you look, I mean,
Yes,
but
no,
earnings growth actual for the fourth quarter is down 3.7%, and it's still trending lower than that.
Well, its
right?
expectations for the full year are
at 1.5%. Or at 1.5%.
Right. 0 to 2% is what is expected.
Where was it on January the 1st? It was 4.5%.
Okay, but I think actually as we go through this year and we get the supply chain issues solved, we have inflation that is parts are coming down, even if it remains elevated. You have the dollar also down about 10%. I think also demand has been a little bit better than expected. I mean, look at Coke this morning, right? I mean, that organic growth of 15%, that's demand. Right? So to me, and that's just one example. I can give you a lot of other examples in terms of earnings. So it is a stock picker's market, and you have to pick and choose and see which companies have pricing power, which actually have seen better demand. And I think earnings as a result I think they're actually going to be better than expected for the full year. Maybe the first quarter, second quarter is a little soft, but I think you're going to see a little bit better throughout this year. And that to me is the most important thing versus what the Fed is going to do.
Does it make